Yeah, so my name is Thordur Jonasson. I come from the International Monetary Fund, from the Monetary and Capital Markets Department. And I've been asked to give you a little bit of perspective on Ireland in the context of the crisis. And I'm quite happy to do that to begin with. And secondly, I'm quite fortunate to be following a very comprehensive presentation by my colleague who has given us like the big picture. So I'll do my best not to sort of repeat any of the sort of the overlying, overarching like structural issues. I've sort of put this into, let's say, a few buckets. So first the crisis and the impact, and then I'm going to try to give a perspective more from the side of the, let's say from the side of the authorities, and in particular the perspective of the debt management. Because obviously debt was, and market access is what we are debating here a little bit today. And so I've come up with a structure that where I've tried to sort of group together the policy responses into appropriate categories, and then I'll conclude with making some considerations. So firstly, the crisis in Ireland. Let's see if I can follow this on my screen as well. So obviously the crisis in Ireland was a banking crisis followed by a property bubble, and that was the sort of underlying concern. And the challenge for the authorities was essentially the recapitalization of the banking system, which was of considerable magnitude, and I believe the Irish banking system was like 8 times GDP prior to the crisis. And in the sort of the turmoil leading up to the crisis, the Irish government had, made a policy response which included a blanket guarantee for bank liabilities. Initially, it was being portrayed as a liquidity backstop, but of course, liquidity and solvency are quite related, and it ended up, being a check of uncertain magnitude that the government had actually committed for its backstop. Now, this was sort of, and I'm a little bit maybe hazy on the exact, timeline, and because in many ways we're looking at it from the onset of the IMF program on the one hand, and then you could also be looking at it from the onset of the crisis, which would be more like 2008. So when the program really came to begin the economic adjustment program, the deficit was already very high, double digit. You were seeing a significant liabilities, and these things were essentially quite difficult. So where am I? So the starting position at the onset of the economic program was that you had a very high public debt, you had significant bank capital needs, and they were uncertain at the time. It was difficult to estimate the state of the bank's balance sheet. And it was going to require a number of different policy measures. First was the fiscal consolidation, which would be providing a great drag on economic recovery. There was ongoing private sector deleveraging. There was underlying inflation, and given that you have the euro, that inflation would require an internal adjustment. And there were ongoing challenges in Europe. Now we have run out of batteries. Battery. So maybe Colin, can you advance the slide? quite the right touch. So, so at the onset of the adjustment program, the needs were about 85 billion euros, quite a big amount. And this is really one of the keys to the story I'm going to tell you is sort of the mix of the supporting finance. And of course, this financing was going to allow Ireland basically to ride out the crisis without having to rely on market-based funding. But the key here is it's not only including financing from the IMF, but also from institutes of the European Union, and also from the neighbors. And of course, the key thing to note is whenever the IMF is providing financing in this context, it's to support the balance of payments, and as by its nature, that type of financing has a relatively short maturity, and it's not necessarily inexpensive. So what happened to debt management? Basically, market access was lost in a way that yields they floated upwards north of 14%, and debt management had to cope very quickly, from being a AAA issuer to going to sub-investment grade and having to deal with new types of investors. And there was a difficult story to communicate because you had all the uncertainty related to the macroeconomic development, but also to the extent of the health of the government balance sheet and the contingent liabilities. On the economic front, there was a need for the internal devaluation to restore competitiveness, and then maybe a few special things for debt management. And maybe one thing to note about Ireland, they had very strong debt management capacity at the outset, and a very tidy portfolio, well hedged and clear benchmark portfolios, and it was difficult to maintain the same momentum once market access had been impaired, because these types of derivatives or hedges they were implementing were difficult to access and more costly. So the first phase of the three was we can call it like a pre-trade, and that was essentially like preparing for market re-access, and it involved a very well-designed and crafted communication program by the debt managers and government officials. And this required not only producing glossy, comprehensive material, but actually getting in front of investors and communicating and having the dialogue on the actual situation. And of course, that kind of a two-way dialogue was very beneficial, because not only were they able to give the underlying facts, but also were able to come away with a lot of information from the market perceptions. So this was essentially the first thing, and then in parallel there was an ongoing effort to improve the profile of the debt and renegotiate the existing package, particularly from the European institutes, to allow for a longer maturity and a lower cost. And obviously that was a part of communicating a stronger message about debt sustainability. So no trades. So phase two, they start moving a little bit closer to the market, and that's sort of beginning with a little bit of again improving the debt profile, an exchange from 2014 to a 15 bond, and obviously. As was mentioned in the previous presentation, a vital part of the package were the actions of the European institutes, like the European Central Bank, which may not have had a direct impact on the funding for Ireland, but actually was very important for market confidence. And the ECB facilities played a vital role in that, because it gave essentially like a liquidity backstop to these instruments that were eligible. Now, maybe the first actual funding operation was a treasury bill issuance. That issuance may it was important, but it was also well organized and well crafted. So essentially everything was lined up, and so there was very little potential for any kind of a failure. And then what followed was further improvement of the debt profile, and also taking advantage that rates were like on the decline. So these operations, they became attractive from a cost perspective, and finally sort of moving into something that's a little bit closer to regular market operations by moving towards syndications. So this is like signs of market access, but full market access had not really been achieved. So what followed was like further improvement in the maturity profile by going to the EFSM and the EFSF and extending maturities further. Again, providing a little bit of space on the maturity profile, spacing things a little bit further out in the future. Essentially preparing for like a full market-based trade. Other instruments that had found its way into the government portfolio, like the promissory note used to recapitalize the banks, they were also extended. And in preparation for market access, there was also an accumulation of a cash balance, which essentially provided the market with a little bit more confidence. And this also avoided the government to access a precautionary credit line that would have been more costly. But sort of in the background, there was like a continued effort for a very proactive communication strategy. Now, finally, maybe the happy story is the market re-access. And when you look at what does that essentially mean, and because we do have maybe a high-level definition for market access, but for each country, market access will have like slight variations, because the normal market access they have in normal times may not be identical across countries. For Ireland, they basically came out with five principles. I mean, the ability to announce the funding plan, to do one-year funding without reliance on official credit, having some kind of a regularity in the auctions. Obviously, rates had to be in a sustainable range from a debt sustainability perspective. And then maybe the aspirational thing was to sort of re-engage the investors they had been able to access previously. So these were the sort of the overarching principles. And again, market sentiment had generally improved with the market, receiving some positive support from the ECB. And this sort of allowed for, further interest rate reductions and term enhancement. And I just include like a few here, like they did a 15-year and a 30-year syndication at very attractive rate. And they were able also to use some of these proceeds to repay more costlier financing from the IMF. And this also in the background, they continue on improving the debt profile. And finally in 14, they received more acknowledgement from the credit rating agencies. So that's sort of the happy story, but just to sort of look at the some of the magnitude of these challenges. So the fiscal consolidation under the program was considerable, 19% of GDP. So this was not an easy. It was not easy being the Minister of Finance. Obviously, there was a substantial fall in GDP growth. Unemployment had reached 15, came down to 10 at the end of 17. Gross debt went from 24% to 123%. And obviously, as they had to take on a lot higher debt levels, they had to term out the debt to maintain a reasonable debt profile. So I have a few slides here with some pictures that you can sort of come back to, but I find this one to be exceptionally nice because it sort of tells the story in a similar way as in the first presentation, but opening a little bit more on Ireland. And maybe the point to note is the program entry here. And this is the yield of the 10-year bond. So when they came into the program, it was like 6. It was peaking at around, in this chart, around 12, 14. There was the downgrade. There were the positive developments in the market and the central bank instrument. And in the background, you had the credit rating sort of responding to these improvements gradually. So the fiscal I'm not going to be going into, but maybe just to highlight again the debt, the magnitude of the debt here. I mean, going from starting in late 2007, it was only about 24%, and obviously peaking at 120, 23 in around 12, 13, but then having been on a gradually declining path. And maybe the other change from the debt management perspective is the composition of the investor base. And here you see the pre-crisis period, and you see this was predominantly market-based financing. And then after the onset of the crisis, maybe, 2 points to note. Obviously, the official financing, grew exponentially, but also using other types of instruments wherever they were possible to access, like retail savings, and also the non-market-based funding, like the promissory note. So this tells also we could actually explain the whole story from this slide. So, and this sort of leads us to today. I mean, what's different with Irish debt management? Well, they have a lot more debt. They have, secondly, they have much longer average time to maturity than they had at the outset and pre-crisis, going from about 5 years to about close to 12, I believe. Obviously, that's going to be helped by the very long-dated official financing. But and to sort of assign that market access has been fully restored, they are sort of following a fairly aggressive short-term maturities. And one of the attractiveness there is the cost of most. So I want to sort of stop here, and I'm happy to take your questions after we've heard from the other panelists. Thank you.
Just a minute to break my presentation. Somehow what I see here in my computer is slightly different from what I see there. First of all, I would like to thank Michael and George for inviting me to make a presentation here. My name is Souto. I have worked in the same division as Michael and my colleague here, Aitor, before getting involved with Portugal. The fund was brave enough to send me there as one of the resident representatives. So I was involved with the design of the program, and then I was making the sacrifice of living in Portugal for 3 years, but it was a duty call, so I did it. I have experienced firsthand the implementation and the difficulties of implementing the program. I must say I may not share the same views as some of my colleagues that already made some presentation here. And in the course of my presentation, I'm going to tell you why. So, the loss of market access. So this is what's said in the IMF report. If you read the IMF report that requested the assistance, that's what we say. It's deep-rooted structural problems that led to lack of competitiveness and high debt. It's lower savings and a rapid rise in tradable activity and related prices. Concerns about fiscal sustainability, which led to increase in sovereign spreads. Bank funding conditions deteriorated sharply. Loan portfolios weakened, and bank exposures to large corporate bankruptcies increased. Interesting part here is the incumbent government did not want to request any assistance. And when it became clear that they could no longer fund the market fund at proper conditions, the Prime Minister requested assistance, but then he resigned. So this led to the situation that we had to negotiate a package with one government, but then we came back for the first review and it was a new government. So we had to ensure while we were there that the opposition was on board with some of the things that we were bring to the table in terms of the IMF, European Commission, and European Central Bank program. Now you can see that the rates for Portugal started to climb up. I mean, all this is true. Here you further see, you know, issues with competitiveness. So there's a lot of rigidity with the labor market, but also there was a lot of regulation in the products market. This was a very difficult point in the program. That in the case of the product markets, it was difficult because there was a lot of vested interest that we were not able to completely break into it. And in the case of the labor market, many of the measures that we were considering, they were struck down by the Constitutional Court. So this was actually a very important limitation that we had to face in the case of Portugal. Some of the desirable measures were not allowed by the Constitutional Court. And we had to resort to second best, third best, or whatever worked at that point in time. We had to improvise on the fly. You can see the horrible fiscal situation in the case of Portugal compared to other countries in Europe. The debt to GDP is, we are among of the highest, and it's not only the private sector debt, it's also the general government. And then there was the favorite topic for the European Central Bank, the loan-to-deposit ratio. This, as we will see, created important limitations because as part of the program, the banks had to reduce the ratio of loan to deposit. You can do that only in two ways. One is you cut the loans, and then you have credit rationing. The other one is you increase deposits. But, you know, it's not like there is a lot of people willing to come to Portugal to make deposits in the bank. So you're basically catering among the same group of people that are already in Portugal. And as we will see, this brought an interesting component in terms of debt solutions, because at some point, the debt management office created some products that were quite innovative, but they were, to a certain extent, competing with the same depositor base. So retail products that were targeting the same depositors that banks were fighting for so dearly. So Christian is not here, but you can see some of the numbers at the end of 2010. You saw some in Christian's presentation. Are you here, Christian? Yes? Okay. So the current account deficit in 2010 was minus 9.9. The fiscal deficit was 9.1, and they were lucky because they had some one-offs that helped them. Otherwise, it would be worse than 9.1. The debt was 92% of GDP, and here there were some issues in terms of reclassifications. Some of the state-owned enterprises that were not being considered in the perimeter of the government debt, that were brought into the perimeter of government debt, bringing the level higher. In growth, 1.2%, you can see that it was cut over there, but the last quarter was horrible, in negative territory, 2011. I mean, all that I'm saying is true, but here's a point that I would like to make. You know, Portugal is a country that for a decade, from 2000 to 2010, grew 1%, less than 1%. This is a population, I don't know if you can read here, but the upper secondary education, the share of upper secondary education is very low compared to the other countries. There is a reason for that. Portugal lived under dictatorship for a prolonged period of time. And during that time, the required obligatory education level, just went down, from secondary to medium to primary and just down the hill. So the older generations that were in Portugal at the managerial level, they didn't have a lot of training, education. Now you can see that from a structural point of view, makes it difficult for you to implement a number of changes in the country. Then we have, that's the medium-term budget forecasts, and you can see that they missed the forecast big time. I have some very interesting charts I didn't bring here, but I have forecasts for GDP, for other, the budget deficit. They never get there, Here is the budget forecast Erce, the real GDP budget. These are not the ones that I'm talking about, but here you can see we have a sense of how much you guys were missing the forecasts, and leading the back, of course, Portugal, Greece at some time, and the same thing for the GDP forecast. So, I mean, these things have been happening for a prolonged period of time. We are talking about a country that didn't grow, that were experiencing fiscal deficit for many years. I think that if Portugal, during the life of the European Union before the crisis, if it met the 2% fiscal deficit once, was too much. These guys have deep-rooted structural problems. So it's not like they can, from one day to the other, start growing, becoming competitive with other products, with other countries. But still, if you look at the interest rate dynamics, there were a lot of investors quite happy to lend money to Portugal at very low interest rates. And that led to a significant indebtedness for the government, for the banks, for the private sector, households. It's amazing in the case of Portugal. It's a problem that has been addressed, it's a problem that has improved, but it's still there. And this is something that countries like Portugal, perhaps it's more accentuated than other countries, but it's there in Europe. It's something that needs to be tackled. The issue of indebtedness and the fact that these guys have loans with the banks. So even though these loans may not be non-performing yet, they could potentially become bad if there is a turnaround in terms of economic activity. Now, find a solution to this is not easy, because to have a more aggressive approach would mean the banks would have to materialize losses in the balance sheets and have to bring more capital. And it's not like these guys are going to grow 2 digits to grow out of this debt problem. So there has been a number of European initiatives in terms of dealing with this problem, but to my mind it's something that if I were an investor, would probably make me feel a little bit uneasy when I look at the prospects of some of these countries. Now, the crisis impact on debt management. Interest rates increase to see, this is the spreads over the bonds, May 2011, 650 bips. The debt management office was only able suddenly to issue treasury bills up to 18 months. There was no appetite to buy anything longer maturity than that. The investment profile changed from long-term investor to short-term investors. And part of this, as we will see, was associated with the credit rating. At the moment that Portugal was became junk status, it was automatically kicked out of many bond benchmarks that many of these long-term investors, pension funds, and more conservative type of investors looking for in terms of building their portfolio. So what was left behind were hedge funds and the guys that are quite greedy, are willing to lend you money, but they charge for it. The credit ratings, Portugal went from AA- in January 2009 to BBB- April 2011. We were there in May 2011 to negotiate the program, and in January 2012 it was already BB. Now Portugal has already regained its investment grade status. I need to tell you that these guys in the debt management office, they were by doing the same building that our office was in Portugal. They put up a good fight, They issued a private placement, 1 billion, early January. Then they had a 5-year syndicated, 2.5 billion, February. And there was substantial short-term financing from domestic markets and banks. Now, with the resignation of the government and new elections, the access to external financial markets just shut completely. And here comes the Troika. This is not a joke. I mean, I find the Portuguese very creative. And there are people that, they have a great potential to be competitive. These are a group of guys that create this board game. And it's in Portuguese, but it says, here comes the Troika. And you can see that Troika are those ugly guys with black suits and, that's how they see us. There is a Greek version, there is a Spanish version. I bought all of them, but I didn't say it was me buying because you know, I didn't want to tell them that I was buying it. And this is how, you know, basically the main elements of the IMF program in Portugal. If I am going too much, just let me know, please. So there were three pillar policy mix. One, we need structural reforms to boost growth. We need a credible fiscal stabilization path, and we need safeguard financial stability. There was no crisis, banking crisis in Portugal until Espírito Santo fell. That's when this large private bank, I left Portugal right before, and I swear to God, I have nothing to do with it. So, because they didn't have the policy instrument to devalue the currency, so the idea was to attempt to achieve an internal devaluation. But to do that, okay, we need major structural reforms. We have to do fiscal policy with friendly growth measures. In the bank system, we have asset quality reviews, increasing capital requirements, and backstop facility. Now, this is the size of support that we provided. At some point, this is going to become available in the net, so you guys will be able to go through it. So if you don't mind, I'm going to skip some slides. And this is a part that's important when these guys started to regain market access. So first, what these guys were trying to do was basically to replace some debt instruments with other, with a little longer maturity than the T-bills, but it's still not 5 or 10 years. In September 2014, they were able to do a syndicated deal maturing in 2030, 3.5 billion at the debt coupon. They have public offers of floating rate bonds. They have US bonds. So they basically started to diversify in terms of the instruments, including a GDP-linked retail bond. This is something that the debt management office offered online, so the individuals could come and buy this stuff online. We can do that too in my country. I'm from Brazil, so you can buy some of these instruments online. Okay. So this is the characteristics of this instrument. 5 years. There was a base interest rate, and then of course something that was linked to GDP growth that would go up and down. Here's the part that there was a lot of commotion in Portugal when I was there. The central bank and the banks were complaining bitterly because they basically say you're competing for the depositors. We cannot afford to lose these depositors to you. And at the same time that you're trying to lower the loan-to-deposit ratio. If you do that, we are left with cutting the credit further. And in fact, there was a point in the program that Portugal faced a credit crunch. And in the office, we heard those very horrible stories about companies that could not get. I am just going to skip this and show you this slide because this is the latest evaluation of the fund, and basically saying that this is a very successful story. The Portuguese economy performed strongly, prospects remain positive, but downside risks exist, and there has been improved access to market financing. So the charts that I'm showing you will basically show that even though the debt level has increased and kept Portugal among the highest levels, you can see that the 10-year government bond yield and credit rate went down. Now, on that one, I echo Christian, because to my mind, what really drove this down was Drag's statement. To be quite frank, I don't think it was economic fundamentals. They have helped, But to my mind, it was Drake's statement. And if you look at some of the fundamentals, especially on indebtedness of the private sector, it has improved. But there is still a long way to go. I apologize if I went too fast. I am sure I missed something important, but I'll be happy to answer questions. I need to warn you though, I suffer from severe selective memory problems. So,
To pick up on one thing you said earlier in the presentation, if the banks had been allowed to write off the bad loans and recapitalize, I know those big caveats, but if they had written off the loans and been able to recapitalize, would that have stimulated growth in Portugal? Would that have actually contributed to the economy bouncing back?
that's a difficult question, okay? Because there were two problems with the credit. One was the supply side. That would have helped the supply side. The other was on the demand side. And some of the good companies that could actually get credit, they did not invest because of economic uncertainty. So they started to postpone investment. So it would have helped to some extent, but not entirely.
Thanks.
Okay, please.
Sorry, you mentioned the bankruptcy of the Banco Espírito Santo, but you don't really, I mean, it's not really related with the crisis that was happening in Portugal. So why mentioning it? Sorry, I'm Portuguese, so I followed.
Oh, you're Portuguese?
Yes.
I'm sorry. You should have told me
Yes.
before I started the presentation.
But we'll talk afterwards. But, I mean, I thought it was going to be showing a successful story, which was only mentioned on the last slide. But I
You
think
know,
this-
it was a successful story
Yes.
because the amount of effort that was put in terms of improving fiscal situation, current account, labor market, product market, competitiveness. You know, when I show that again, I'm being honest. You know, I really think that Portugal has a number of products that are at par with best countries in the world. Wine, shoes, textiles, and you keep going. You know, why I mention Espírito Santo. It's more of a self-redemption because we feel we probably could have tried to identify some of the problems beforehand. Now, in the case of Espírito Santo, it was very difficult. Why I say that? Because it was a fraud problem. Okay? So at some point, towards the end of the program, and I was there was a lot of effort from the central bank. They hired consultants to basically go through, the ownership structure of the bank, not only the files, loans, and etc. They had a very intricate ownership structure that at some point of the program, they actually used it to internally create 1 billion euros in capital to meet the capital increase that were required from them. Now I have to ask you, you're not from the Espírito Santo family, right?
No.
Okay.
I was the competitors. So.
Oh, okay. So, but you are right. This has not to do with yeah. I'm sorry. My colleagues will probably kill me and say anything else. Thank you very much.
Okay. Thank you. The presentation that you just saw and the other presentations, they are going to be uploaded in the GIC website. Now, some of them, they are going to be immediately available after the conference, immediately in the next few days. Some of the presentations from the IMF, probably you know that they need adequate clearance. And some of the presentations, they have not been cleared at the moment. So the presentation of Marcos is one of them. So you are going to be seeing it, but it is going to be taking some kind of time before you are going to be seeing it uploaded. Just a warning for you if you are going to be looking at the presentation, the interesting presentations that you see today. Okay, thank you again. Then we're going to be proceeding with Cyprus. We are going to hear Mr. Polykarpou, who is from the embassy of Cyprus to the United States, and he's going to be giving us, he's not going to be having any slides, but he's going to be giving us some kind of remarks, and the panel is going to be closing with some remarks from me on Cyprus, but from the point of view of the panel. Mr. Polykarpou.
Thank you very much. So, indeed, as Dr. Ioannou, whom I congratulate and thank very, very much for inviting me, same as Professor Tsetsegos, said that I don't have slides, so in that sense, as a diplomat, I am a bit more traditional in my presentation. I would like to thank you all for being here. I would like to thank and congratulate my fellow panelists, and I dive directly to the speech. So, what I have from the Ministry of Finance in Cyprus, whose hierarchy unfortunately couldn't make it today, is the following. So, since 2007, which was the year when the global financial crisis began, the European banks started to face significant challenges. We had to deal with concepts and issues such as banks being too big to fail, or even banks being too big to save. And that was a tough dilemma for everybody. The result is known. European citizens had to make painful sacrifices in order to keep systemic banks alive. The financial crisis had turned into a sovereign debt crisis, as governments had to intervene to save what it could be saved. Unavoidably, government debt levels soared and countries fell into recession, with rising unemployment levels and poverty spreading, unfortunately. A prime example of such fate is undoubtedly the case of Cyprus, for which I have been invited here to talk about. An economy which was running with an average growth rate of almost 4%, with almost full employment at the time, which then turned to an almost complete economic chaos. To give you a sense of the gravity of the situation, I know that early in 2013, the cash reserves of the government were enough to carry us only a month. Market access had been lost 2 full years earlier, and tight capital controls and domestic restrictions had just been imposed, and the real economy was already in deep recession, with unemployment having risen to unprecedented for Cyprus levels. The root causes are to be identified in the unsustainable credit expansion of the previous decade, a resulting property bubble, and of course the unsustainable course in public finances, which is an element that Christian referred to earlier. Social transfers were also always on the rise, even at times where unemployment was well within the natural level. Welfare benefits were offered not on the basis of credible and uniform welfare criteria, but rather on the basis of electoral cycle and satisfying pressure groups. The Republic of Cyprus was basically in an urgent need to take bold and painful measures to prevent the economy from collapsing. The only way out was an agreement of macroeconomic adjustment program with the ESM and of course the IMF, though which were necessary financing could be safeguarded on the premise that the agreed reforms would be implemented. And in our case, we had a difference compared to what Marco said before, that had to be taken or inherited better to our government, who was just elected 15 days earlier, back in 2013. They had to take difficult decisions, and by the way, this government is still in place after the president was re-elected in 2018. So, as people say, including economists, the times to repair the roof is when the sun is shining. In the case of Cyprus, however, we had to fix the roof when the rain was pouring down. And I remember the period in Brussels. Actually, that day it was snowing in Brussels. Firstly, what we did, we implemented a number of front-loaded fiscal consolidation measures, mostly on the expenditure side. Actually, the ratio of expenditure cuts versus taxation measures was around 5-1. Maintaining a stable and competitive tax regime was a key aspect on our economic policy at this crucial prerequisite for the business, new investment, and guess what? New jobs. The prudent fiscal policy we have been implementing since then has resulted in high nominal and primary fiscal surplus with well-targeted expenditure policies. For example, the growth of the wage bill has been linked with the nominal growth of the economy. Social expenditure have been targeted to those mostly in need. As a result of these policies, general government debt came down significantly at the end of 2017 to around 96% of the GDP, exceeding a decline of about 9 percentage points of GDP in a single year, the biggest improvement in the EU. At the same time, we have reformed our banking system. An oversized banking sector with inadequate supervision, regulatory framework, and corporate governance that was responsible for the unsustainable credit expansion during the decade following the EU accession. The banks have been significantly restructured and recapitalized, and we are refocusing their operations with a prudent, risk-based approach to lending. Through various measures, both from the government side, but also from the banking side, the level of non-performing loans has considerably declined in absolute terms, even though it's still high in percentage terms. In fact, there has been a significant reduction of NPLs from the peak of 28.9 billion euros to around 11 billion euros in 2018, which consults a decrease of around 60%, which is the biggest fall experienced in the EU. These measures include a three-pillar strategy recently implemented by the government that involves the following. First, the strengthening of the effectiveness of the legal framework. Second, a burden-sharing scheme between stakeholders and state support in order to address the most challenging portfolio of NPLs, that is mortgage of SMEs loans having the primary residence as collateral. Third, addressing challenges faced by the Cyprus Cooperative Bank through its orderly resolution and the creation of an asset management company which acquired its bad loans. On the structural front, we have taken significant and bold measures in the areas of financial management, civil service, welfare, pensions, and healthcare. It is through such reforms that we can lay the foundations for sustainable public finance and even for a more robust and sound economic model. The Cyprus economy of today is running again with growth rates close to 4%, much higher than the EU average, whilst medium-term prospects are in the range of growth of 3% annually. Key productive sectors of the economy, including tourism, shipping, and business services, have proven much more resilient during the crisis and continue to constitute the main growth drivers. The tourist industry is experiencing record performances with potential for growth further. Even the hardest hit real estate sector is showing clear signs of recovery. And of course, there is the energy sector, which includes the offshore natural gas findings in the exclusive economic zone of Cyprus, which constitute a significant upside risk for the Cyprus economy. And now allow me to very, very proudly share with you the news of 2 hours ago. Today in Cyprus, ExxonMobil and the government of Cyprus announced for the first time the results of the drilling of ExxonMobil and Qatar Petroleum, and they announced that they found 5 to 8 TCF of gas of perfect quality, which is one of the largest findings for the last 3 years worldwide. Of course, that shows that the Cyprus has a potential to be an alternative indigenous supplier of gas in the EU, and that for us it's very, very important. Which of course doesn't mean that we solve all our problems, but I think it's great news to share with you. To wrap it up, the remarkable turnout of the Cyprus economy is culminated by the return to an investment-grade status by credit rating agencies, sending a strong message to international investors and allowing Cyprus to borrow from markets at very competitive rates. In fact, a few days ago, Cyprus was able to issue a 15-year bond with an interest rate of around 2.75%. Nevertheless, we acknowledge that challenges remain, and this is not the end of the road. In this context, the Cyprus government is committed to continue its efforts for reforms. It is clear, however, that macroeconomic stability has been steadily re-established and confidence has been restored. Thank you very much for your attention.
Thank you very much, Mr. Polykarpou. Thank you, Konstantinos.
Pleasure.
We are running a bit late, and we had a presentation on Cyprus from the point of view of the IMF, which would last normally about 10-15 minutes. Probably I am going to be spending only 2-3 minutes in order to give you some kind of highlights. And the last presentation for this session that it had to do with the collective action clauses and how they affect sovereign borrowing, we are going to skip it. You are going to be seeing it in the website, the GIC website, when it's going to be uploaded. I apologize to Aitor that he was the moderator for this session, that he is not here because of our mistake. We had to introduce him and we did not. Now, he has also some very important questions that probably he would like to also raise before we are concluding this kind of a session. Now, I do not know. It's going to be up to Aitor how he wants to pursue that. And after these few slides that I'm going to be showing showing you for Cyprus. I am going to be asking Aitor if he wants to pose some kind of questions. We are going to have a few minutes of questions and answers based on the presentations already, and then I'm going to be handing it to the chair of the second session, Mr. Rafael Molina. Now, let me try to find here. Colin, could you help me here with the presentation? Okay. You heard from Konstantinos the gist of the situation of how the stress period for Cyprus came, what were the main measures that they were taken, the policies, and also the outcome and how we have they have moved forward in terms of resolving the oops. Okay, here we are. Thank you. Of how they have resolved the issue. Now, let me give you a very short overview of this kind of presentation. We have put here the motivation, the causes, the processes, the IMF involvement, the outcomes of the Cyprus issue, and also some of the lessons that we are getting from the experience of Cyprus. Now, the motivation, as we said, also, and we heard it from the previous speaker, is the issue of resolving something that it came in the context of the whole European, for some sovereign debt crisis, for others debt crisis, for others just European crisis. And it is, first of all, why did Cyprus restructure its debt? That's what we are going to give it in the next slides. How did the debtor-creditor relations, how the process of resolving these issues came about? The third aspect is the outcomes, what we have seen in terms of the fundamentals, how they moved, and also a few words on what we get out of the experience of Cyprus. Now, the causes. You heard also from Chris earlier, you heard it also in the context of the presentations of Ireland and Portugal, of some of the major issues that they came before the crisis. And the Cyprus case, it's also a mix of what we have seen in the other two cases. Large imbalances and domestic credit expansion during the years before the crisis, the expansion of the fiscal policies that we had seen in the period between 2009 and 12, and the fiscal costs that they were coming from the bank resolution in 2012. This kind of a chart is very revealing of what was happening in the case of the public debt and the primary balance. We see the peak in terms of the public debt, which is represented by the bars, and the red line, it shows the primary balance and how they moved over the 10 years before the crisis. Not a pleasant situation if you are an authority in the country. Now, the process of the debt restructuring, so we came about the issue that it needed to be tackled, the stress that we had in the banking sector in particular, but also the loop that we had that it was feeding into the sovereign. Now, the issues that they are in every restructuring is, first of all, what kind of the debt is going to be included in a restructuring, what is the eligible debt, and that it was a total amount of 1 billion domestic commercial bonds that they were issued under domestic law, and they were in euros. The second issue is how quickly the restructuring is proceeding, in other words, the negotiations, and we saw something of 2 months, which is remarkably short based on the experience that we had for the other cases. Now, it was a strictly preemptive restructuring, so we did not see any default, and in the case of the restructuring process, we did not see any creditor committee that it was formed. Now, the other essential parts, in order to be having just a peak of this kind of a situation, we had no nominal reduction in the exchange offer when we had the exchange. There were no CACs that they were triggered, collective action clauses that they are in some bond contracts, and they were in the bonds that they were eligible for restructuring, and the credit losses based on some estimates, the net present value haircut of 36% on average, using some specific exit yields in this kind of a case, 12 to 13%. Now, these kind of charts, they show who was affected by the restructured bonds, and we see that the restructuring, how much the holders of the debts that the bonds that they were restructuring, what was the impact, and we see that there was a larger net present value reduction for short-term remaining maturity bonds or holders of bonds with short-term remaining maturity, as it has been in most of the cases. So this was not an exception. IMF involvement, approval of a third-year arrangement under the EFF, Extended Fund Facility, was approved in May of 2013. It was about 900 million SDRs, almost a billion of a program. It was exceptional access. It was front-loaded with fiscal adjustment, meaning that certain adjustments they had to be done in the fiscal accounts before the program, and as part of the program, it was the debt restructuring of the accounts. Now, the rollover and the extended maturity of the domestic debt, that it was part of the adjustment program. It had to be also be looked very thoroughly, and also this was part of the, I would say, one of the best cases in terms of country authorities and also the IMF and the European partners in terms of the restructuring process. Now, the outcomes, we had the substantial debt service relief. The important thing it was that debt service of around 700 million euros that they were due in the second half of 2013. It was moved to 6 years later. There have been a slow recovery in credit ratings, but the market access, as also Mr. Polykarpou said, it was a quick market reaccess, which is something that all the programs, when you have the IMF and also the other partners that they are involved in a crisis situation, in a restructuring situation, the major indicator of a success is how quickly the country it can go back to the markets. And we have seen that they have going back to the markets in a gradual but decisive way. Now, as you can see over there, what we mentioned a minute ago, that we had the debt relief, it has moved to the second half of this year, and also we have seen that the government, and also as we heard earlier, the authorities, they are moving forward with new issues in order to be covering the outstanding redemptions that they have. Now, I'm closing with this kind of a very brief summary of what are the lessons. Strictly preemptive restructuring strategy and quick debt negotiations that we saw in the case of Cyprus, and this is something that I would say a good practice if a country has to go into the area of restructuring of its debt. The second lesson is a comprehensive fiscal adjustment package when the country is coming to this situation and it is determined that a debt restructuring is needed. The adjustment should be comprehensive and it should be as quickly as possible and as front-loaded as possible. And also the other lesson that we have learned from this situation is that the substantial debt relief is always coming with the reward of quick market reactions. So let me start here with this kind of a quick overview of the situation and also of the restructuring process, and ask you if there are any questions with regards to Cyprus. Now, okay, then I can ask Aitor if he can pose some of the questions that he had prepared for this session, and if the panelists, they can, or anybody from the attendees, they would like to also to bring forward with questions and answers.
Hello everyone. Many thanks, Michael. Many thanks all of you for the presentations. So I have a question for each of you, right? And like the question sort of links a little bit to the perspective that we have at the ESM regarding what's going on with these countries, right? So for each of them, our line is that the programs have been very successful, right? Our line is as well that, I mean, this can be seen in the fact that these countries are growing really fast, currently faster than is happening for the average of the euro area. But we are also of the opinion that there are some underlying vulnerabilities in each of them. So I'm going to mention them and then throw them to you so that maybe you tell us something about this, right? So in the case of Cyprus, so output is growing above potential currently. So given that it's growing above potential, is to be expected that, or maybe not, I don't know what's your view, is to be expected that at some point this is going to go to potential or below. So we wonder whether the country is going to be prepared for that part of the cycle when output goes not above potential but like below potential. In the case of Portugal, so this we were discussing at DSM like last week, is all this issue with the massive surge in tax revenues, right? So for the last 2 years, like the tax revenues in Portugal have been growing really, really rapidly, much rapidly than GDP. And here again, our concern is that because we don't really understand why this is going on, I mean, we fear that at some point all these tax revenues are going to disappear. And then what? So I don't know if you have a perspective of why of this climb in tax revenues and whether you fear that these tax revenues could disappear. And then on the Irish case, I mean, for Ireland, everything is embedded in this massive amount of capital that is flowing into Ireland, the fact that there are all these firm profits that may be shipped to Ireland and maybe becoming GDP, so that actually part of the dynamics of the debt to GDP ratio, what they are simply showing is the fact that Ireland is a very attractive destiny for some kind of profits and to store them there in some specific forms. So again, like we are concerned about like how sustainable is this and what this could mean for the country going forward. Thank you very much.
Thank you, Aitor. So should we start with Ireland and then we can go to the others?
Yeah, I think Ireland continues to be a very special case. I mean, if you contrast Ireland with the other countries we have covered here this morning, you know, the Irish economy was like a high growth, has been high growth, high performing economy for decades, you know, of course with the exception of the crisis period. Obviously, it remains a special case with the presence of large technology companies, Apple, and also it being a popular destination for capital because of the corporate tax regime. And there are, however you calculate GDP, there are going to be, you know, it's going to be impacted by these companies even if they do not have anything but a notional presence in the country. And then the risk that you mentioned, that you are inflating GDP, is a legitimate concern. And obviously, if you want to calculate the ratio of debt to GDP, that's going to be showing the very nice downward path. But and I say this with the caveat that I'm sort of not covering this angle of the Irish economy, so take my response for what it's worth. But however, if you look at all the conventional measures and you look at the fiscal, and I would sort of say, okay, let's take a look at the fiscal. Is the fiscal regime credible and well managed? Yes, it seems to be so, but is that also being affected by taxation and revenue coming from this part of the economic activity that could be more vulnerable to changes? Would there be any changes in the tax regimes being pushed in from various directions? So yes, this is going to be one of the risks facing the economy, but whether it's the main or a key risk, I cannot really tell. But we can take a look at the latest Article 4 report on Ireland and look at the risk assessment matrix, and we can see some better justification for these concerns. But it's also interesting, like for this, ESM is sort of in this role as a creditor to and is sort of legitimately concerned about the credit quality of these institutions. So that's also a very interesting perspective to have. So, Marcos.
Aitor, I think that the question that you're posing is a very important one. It's the issue of this sudden surge in tax revenues in Portugal, and then the question whether this is sustainable or not. So that you derive policies in terms of that. Now, I need to be 100% frank with you. I am not familiar with the new developments in terms of tax revenue. Maybe someone here that has done some work on this. I see a colleague from the OECD.
I can help a little bit, because so the tax revenues right now are increasing due to the fact that we've had already 3 amnesties to Portugal, so money that was not declared is now being declared. And with that, thank you. And with that, you have nowadays a lot more money that was before not declared. Now it's being. So I was working in a private bank in Switzerland. My clients were Portuguese clients, and of course, even though we would say we're not involved if they declare or not, we knew. And now we know that almost, I would say 99% of the money overall is now also being declared. Second thing is also involved with the fact that we now have a lot of performers that are starting to being attracted to move to Portugal because of tax reasons. It's more favorable. They get for a while if they are not being. So, that's not really involved in the fact that the revenues are increasing, but still, it will be sustainable in the future because we will start getting those tax revenues in the future. So, in my opinion, it will be sustainable.
but I'm not an economist, so.
Thank you. Thank you. Konstantinos, you would like to say a few things, or?
Thank you very much, David. Thank you for the question. Yeah, I'm not an economist either, as everybody realizes. Well, it's a very important question. On the outset, I would say that with regards to Cyprus, I don't think that we experienced a tax revenues issue. I mean, collecting taxes, if that addresses your question, especially after 2000. What I can tell you though is that as the other fellow panelists mentioned, Cyprus has its can and is trying to use all the comparative advantages that it has, which is, for example, same as Ireland, we have a very low corporate tax, and that facilitates our revenues to flow, and it facilitates the vision of the government of the Republic of Cyprus to bring Cyprus in the very center of our region, for example, in the Eastern Mediterranean, to attract investments from our region, from the European Union, etc. And that goes hand in hand, of course, with the issue of energy, which is for us very, very important and pertinent. That, of course, will not solve all our problems, far from that, and that's known. I mean, I don't want to mislead our fellow participants here. The reason for which we are promoting this kind of asset, let's say, is very simple. It's of course a new aspect in with regards to the policies around Cyprus, both economics and political considerations. It brings we managed to bring together countries of our region, which was not conceivable some years ago. For example, Israel, Egypt, Jordan, Greece. In the future, why not Italy or France? And of course, the great aspiration would be to bring the United States in. Because the United States, Washington is also on board with our trilateral, they are called trilateral corporations. And of course, the focus is not only energy. I mean, we have other elements there. It's cybersecurity, it's tourism, it's investments, etc., etc. So these are aspects that we are currently promoting. And of course, the aim is not only political. I mean, we're not only trying to stabilize our region. We're trying to maintain, through maintaining stability, we're trying to upgrade the living conditions or development or the flow of investments of all of the countries of the region. And that's, for us, one of the highest considerations we have, and we are aspiring to be at the center of this policy. Shipping, we have high hopes in shipping. Cyprus has one of the biggest fleets for sure in the European Union, maybe worldwide as well. We have high hopes there. The newly elected government upgraded the Directorate of Commercial Shipping into a ministry, so we have been more active for the last 1 year in this regard in the European Union, but also in the region and in the United States. So I was just trying to convey to you some of the aspects that we have in mind and we are trying to use in order to try to get steadily outside this vicious circle of this last crisis. And I hope I replied with your question. Thank you.
Okay. Any other comments, any other questions before we close this session? No. So thank you very much, gentlemen. For the